very good first round of the discussion today, and of course, a very nice and engaging coffee break. That's the beauty of this kind of events, where, as we discussed in the morning, the new normal, and how it's going to change our lives in terms of how we work, how we do our knowledge enhancements, how we network with people, how we meet with other business associates. So I hope today's day is very interesting for all of us over here. As we move on to the next session, it's my honor and privilege to be here today to moderate the session by Karan Bhagat. Karan Bhagat is the MD and CEO and founder of the IIFL Wealth and Asset Management business. Friends, many of you already know Karan as a very large and visible name in the industry. But I'll share one or two small anecdotes, which maybe, of course, it's known information. But at the young age of, as a teenager, Karan started a travel agency of his own as an entrepreneurial venture. And in some form or fashion, that did not really go as per the plan. So Karan had then shut that down. And later on, much further down in his career as a person in early 20s, he finished his graduation and he was working with the wealth management, heading the wealth management division of one of the large platforms of the country. At that point of time, that old entrepreneurial bug hit him and he said that, no, I need to do something of my own where I can make a difference. Like we heard earlier in the day, how Mark mentioned that for all of us friends, as finance professionals, it's important how we can make a difference to the society at large and to add value to our clients and our investors. So with that kind of a backdrop and background, Karan also set up his own venture along with a couple of co-founders where they set up IIFL Private Wealth and grew that from a platform to today a very large conglomerate, one of the country's largest platforms for wealth and asset management. So it's great today to be able to talk to Karan and hear his views about what next in this particular field of wealth management, how today's era of disruption changes is going to change the way in which we look at wealth management as a setup and how clients need this kind of a specific service, what kind of areas which we believe are going to change in the next couple of years, and of course how the recent pandemic crisis has taught us changes. So with that, I'm going to request Karan to come on stage and share his keynote address. And after that, in the meantime, while Karan is speaking, I request all of you to put down your questions and your thoughts, and all the questions will keep collating and we'll get an opportunity to raise to Karan. Thank you, everyone.
Thank you, Anil, for all the kind words. Obviously, I'm slightly taller than Anil, I guess. But good morning, folks. And let me start off by saying this is a session where I'm going to preach to the preached already. All of you are thought leaders in your own respect. And given the fact that I'm speaking to in a CFA summit, I must submit to you guys that after finishing my MBA in 2001, I thought I'm a rock star and I can clear any exam. And I think it was in the year 2004 I decided to give CFA level 1 or maybe 2003. And honestly, I thought I've learned everything in life and I don't need to prepare. And as life was to have it, I got a big fail in the first attempt of CFA level 1. And fortunately, I was brave enough to go and try it again and clear it, but never ended up giving level 2, level 3. But again, to start off saying deep admiration for all of you guys who are, number one, cleared it, number two, who practiced it, and people like Anil and the entire board who spent a lot of time, I know Navneet's an active member, spread it across through the entire country in different events and formats. So a big congratulations to all of you and especially to the entire CFA team to making this happen. Now coming to the topic for the day, which is really on the wealth management side, I thought I'll kind of not go through a very big presentation, but what I'm going to do is talk about really 4 or 5 big trends for 20, 25 minutes, and then maybe open it up for question and answers along with Anil, right? So I think the first thing which is really core to our business is the size of the market, right? So I think what we are all blessed, and this is what we all keep talking internally, that there are some choices we don't make. It happens automatically. And in some senses, we are blessed, right? So we are blessed for 3 or 4 things. Number one, we are blessed given the fact that we're born in a country like India. Number two, we are blessed because we, by default or by choice, okay, either way, ended up being in an industry called wealth management. For me, it was by default, not by choice. If somebody would have asked me post-campus, one thing I didn't want to do it was going out and selling to clients, okay? But as life was to have it, the only thing I did was going out and selling to clients. So the second thing which happens to us is something which happens by default, not by choice. And we are lucky that we are in that space because we are in a sector which is growing exponentially for the last 20, 25 years and will continue to grow exponentially for the next 25, 30 years. Now, why will it continue to grow exponentially, right? So there are certain trends in wealth management which are very, very important. So for example, for the first, let's start on discussing on the stock of wealth itself, right? So on the stock of wealth, we have, the obvious ones. We've got the entire mutual fund industry. I'm not going to split between corporate and wealth and stuff like that, but that's nearly 34 lakh crores. We've got the alternates industry, which over the last 6 to 7 years has grown very quickly from practically 0 to 5.5, 6 lakh crores. The PMS industry, even if I exclude all the provider PF mandates and so on and so forth, is another 6 lakh crores. So we've got nearly 45 to 50 lakh crores just between these three pots of capital. We've got the entire market cap, which is, let's say, 250 lakh crores. Approximately 10 to 12% of that will be, again, retail money in some form or format, okay? That's another 30 lakh crores, plus eventually fixed deposits and bonds will also come into the pool of active management. So the size of the stock of this industry is very, very large. Interest rates in India are fairly high, continue to be high in the region of 7 to 8%. Equities typically ending up giving somewhere between 10 to 12%. So if you look at portfolios over a period of time, just the mark to market on these portfolios is anywhere between 8 to 9%, right? So effectively, you've got a stock of wealth which is nearly 100 lakh crores, which is the addressable segment, which automatically every year is growing by 9 to 10% every year, right? So for us, as individuals to manage the money, that itself is growing. Second is the pot of new money which is coming to the market, right? So every time there's a new monetization, there's a new ESOP, there's a client selling his business and ending up getting financial assets, that is adding net new money to the industry. And third is the entire GDP growth, right? So the GDP itself is growing the entire wealth of the market. And obviously, fortunately or unfortunately, the 5 to 6% people who file returns, their wealth is obviously growing faster than the rest of the country, right? So if the GDP is growing at 6 to 7%, potentially the wealth of these individuals is growing at 8, 9, 10%. So actually, if you take into account all these three, which is the stock of wealth growing on a mark-to-market basis of 8 to 9%, you've got the existing people becoming more and more wealthy, and thirdly, you've got net new money coming into the market. So you've got an industry which is practically going at 25, 30% a year, with a base of 100 lakh crores already in place, right? So obviously, it's a very, very exciting place to be in. And from an industry size perspective, it's something which gives me a lot of confidence to say that I want to be invested and I want to be a part of this industry for the next 10 to 15 years. The second trend, which is very, very clean and very clear, is geographies, okay? So geographies obviously is a direct correlation to both awareness of financial assets, okay? Now, obviously, people still do 5-year fixed deposits at 6.5%, 7%, fully taxable, versus doing, let's say, a 5-year GSEC fund, which is giving 760, 770. Post-tax will end up at 680, 690, versus a fixed deposit at 4.5, 5%, or 4% post-tax. Needless to say, a GSEC fund in Government of India bonds is safer than doing a fixed deposit with a certain bank and has a 2% higher return, okay? But you still got a sizable market, if not a larger market, on fixed deposits versus GSEC funds, right? So that is obviously at the heart of it. It's a lack of financial awareness. It's a lack of people like all of us in this room having reached out to the right set of clients with the right set of financial education. But as financial awareness grows, and it will grow city by city, it's only going to be a function of time where the size of this addressable market will not remain in 10, 20, 30 cities, but it will keep going larger and larger. I think for firms like us, we are still restricted in the top 15, 20 cities. The next 20, 25 cities, hopefully we'll get to in the next 3, 4 years. But banks, independent financial advisors, asset management companies will be able to get to these cities substantially faster. The second big trend in terms of the growth is obviously going to be NRI markets, okay? NRIs, obviously, after having lived in India for a long period, after lived out of India for a long period of time, continue to put in a larger and larger amount of capital. And there, honestly, we've also kind of, in the last 6 months, we're already benefiting in some ways from the China plus one kind of angle, right? So emerging market funds across the globe have anywhere between a 25 to 35% allocation to China. And that's something which most large institutions and NRIs are worried about. They want to increase and allocate slightly more money to India, which effectively in some ways is a derivative of all what's happening globally. either from a macro perspective or from a political perspective or just the China plus one, right? So effectively, there's a very large bank. I think Goldman 3 months back just launched its first fund, which was typically emerging market funds used to be ex-Japan. Now you're seeing emergence of funds which are ex-China and ex-Japan, right? So effectively, imagine an emerging market fund which is ex-China and ex-Japan. Effectively, you'll see at least 25-30% India participation coming in, right? So from a growth of the market perspective, I think there are three big things. One obviously is going to be the geographies. Second is NRI markets, especially Dubai, Singapore, London. US is a tough market to access, but these markets will become very large. And thirdly, the institutional market for all of us, from an India perspective, will become larger and larger as the options kind of dry up. And a third thing which is changing very, very quickly is the entire product complexity or simplicity, whichever way you want to look at it, right? So you've got both sides growing equally fast. On the product simplicity side, you're seeing ETFs and a variety of them growing extremely fast. On the extreme north side, you're seeing product complexity expressing itself through alternates largely, because that's the regulatory platform it's possible to do on, also growing very, very rapidly. Just to kind of look at things and break it up, these are the kind of evolutions which can happen very fast, right? So you've seen the entire mutual fund industry, maybe I don't know when did it start, but maybe last 30, 35, 40 years, grow from nearly zero to maybe 34, 35 lakh crores, of which I'm now guessing a bit. Navneet might know the numbers better. 50% might be actively managed in equities, right? So if you see the broad fee pool of mutual funds is approximately, let's say, 70, 80 basis points on that 15 to 16 lakh crores. AIFs in the last 6 years have grown from 0 to 6 lakh crores, okay? Just as a comparison, on the 15 lakh crores, all of that growth has happened in the last 5.5, 6 years. So it's nearly 40% of the fee-paying market from a mutual fund perspective. On the other side, you'll see ETFs becoming very, very large. You'll also see the alternate market becoming very large. You'll see a lot of new products coming in. The products won't be limited to exotic products, okay? There'll be a lot of products which will be fund of funds. There'll be a lot of products which are relatively simple but have a differentiated strategy. You will have the option of doing credit. You'll have the option of doing private equity. You'll have the option of doing some bit of bespoke solutions in terms of long-short funds. You'll also have the ability of doing a lot of customized mandates for clients, okay? So the product complexity and simplicity both will continue to improve. And obviously in countries like India, the ability to fraction and, kind of sell the right set of products to the clients is not only a function of the product, but it's also equally a function of fees and tax, right? Because those two elements are very, very important for a client before he decides to invest into anything. And tax is a very important variable in India, because it has practically an impact of anywhere from 15 to 30%, depending on the product you're kind of ending up doing. So I think from a product platform perspective, we've all underinvested on the product side of the business for the last 25, 30 years, both as wealth managers and asset managers. I think those are teams which we'll have to really invest in a big way. For example, for a wealth management business, a product platform includes everything, right? It includes an NBFC, it includes the brokerage part of the business, it includes trust and succession planning. It includes the ability to do diligence on third-party managers. It requires the ability to understand the client, innovate, customize, and get him some offerings there. It requires the ability to offer him direct bonds, direct stocks. You need the entire plethora of activities to kind of come in. And so obviously not all of these activities can be in-house, but the ability to have great in-house coordinators who can work with experts externally to be able to deliver the product platform to the client will be extremely, extremely important. And there's no end to the depth of this program, right? It'll continue to improve over the next 5, 10 years. The next thing which is changing very quickly, and we've seen it change across the globe, and in some sense we've been pioneers of that also, not by itself, but just learning from the global examples, is the engagement of clients with wealth managers. That's the fourth point I'll kind of quickly try to address. So the engagement patterns are changing very, very quickly. I think clients innately, whether they realize it or they don't, they want to see holistic advice come from the wealth managers, okay? So that's very clear. They don't want a product advice only, but they want to hear a holistic advice. That's for certainty. Whether they want to pay for it or not is a separate issue altogether, but what they want to hear is holistic advice from the relationship managers. The second thing they really want to do is, sooner than later, they really want to be, in some senses, in their own heads, having 2, 3 core advisors and a multiple set of, and having yet the ability of going out and being able to choose the best set of products. The third, obviously, everybody wants to set up a small kind of quasi-family office. What we are seeing is there are really two kinds of family offices being set up. One kind of family office we are seeing being set up is where the onus of decision making is within the family office. So the family is really going out and recruiting a team which by itself is capable of making decisions. Now, typically this happens in sizes which are typically very large. Not seen it in most families which are below $250 million, which is 1,500 2,000 crores. But the family offices below 1,500 crores are more or less recruiting very smart people who in turn can work very closely with wealth and asset managers, okay, to define their proposition. So I think family offices will emerge, but most family offices will be of the second variety as opposed to being of the first variety. From the other segment, in terms of just the engagement model, I think what we'll see, as we saw across the world, we'll see a discretionary portion also coming in. Okay, so as clients become more matured and maybe money moves to the next generation, you'll also see clients coming and say, you know, I want to define the investment portfolio statement, but I don't need you to come back to me for every decision, as long as the floors and ceilings of the IPS is being respected. Okay. In our own business today, we are seeing a very strong trend of nearly 5 to 10%. It's as low as that, but it's for us as high as that. 5 to 10% of the all new incremental flows coming on the discretionary side as opposed to coming on the non-discretionary side. That obviously has some advantages. It puts the onus of performance squarely back on us. It allows the client to be 100% sure we're going to work within a very, very tight framework. And most importantly, it allows him to, and the relationship manager, to focus on the broader definitions rather than focusing on every instrument level decision. So I think from a trend perspective, it will more or less move towards advisory. Some clients, as trust builds up, will move more and more towards discretionary. And remember, as the business model for wealth managers moves more and more towards advisory and discretionary, there will be an automatic fallback on the mutual fund business for us, where more and more of the incremental allocation will move towards ETFs on the large cap side. Obviously, multi-cap, focused, mid-cap, all of that will continue. But the large cap allocations will more and more be substituted by ETFs as we go along. The other fifth point I'll kind of just spend 2-3 minutes on. I mean, we try to analyze how do we get clients and how do we lose clients, right? So that's a big part of our exercise on a daily basis, right? So how do we get clients was very important, and you know, it's an example I often quote. It's really difficult to enter a client's office and tell him exactly what I told you 2 minutes back, which is the entire advisory pitch, because it's like going and telling a client that you know, you're dealing with person A, B, and C, but hold on, this is this Superman D who's walked into your office, and I can advise you better than A, B, and C, right? So the ability to convince the client of that is virtually impossible on day zero, okay? So the first acquisition of the client, more often than not, in more than 50 to 60% of the cases, unless he's got a whole quantum of new money and he's kind of redesigning his portfolio, more often than not is through a product and not through an advisory pitch, okay? Because the client on day zero is not able to see the differentiation. And therefore, internally, we always say good new innovative products is like Sacred Games to Netflix, right? So I don't know how many of you remember Sacred Games, but when Netflix launched in India, Sacred Games was one of the big reasons why all of us subscribe to Sacred Games, right? So you've got multiple platforms. You've got Sacred Games, Hotstar. So all of these guys, once they have one popular hit, we all go and subscribe to it. And hopefully, as we subscribe to it and get used to the content, we continue the subscription, okay? So to a certain extent, good new innovative products is like Sacred Games to Netflix, okay? So we use that to enter the client, but then really it's the onus of the platform to ensure that we are able to ensure these clients move away from being a distribution client and are able to buy into the platform. And therefore, they are able to buy into advice, either discretionary, non-discretionary, over a period of time, right? So the entry hook needs to be maybe a product, but as you spread it over the next 3-5 years, it's very important. So typically, where do we lose clients? We lose clients if they come into a product and we're not able to migrate them. We didn't profile them well. Maybe the size was not enough. Maybe we've not showcased our entire platform to them, okay? On the flip side, let's say in a firm like ours, if a client's above 10, 15 crores, he's been with us for 3 years, he's seen the entire platform, our probability, the great thing about our business, our probability of losing that client is 1 in 1,000, right? Because he's wedded to the platform. We actually end up losing less than one client out of 500 or 1,000 in a year, provided he's scaled up to a certain size and he spent more than 3 years in the platform. The biggest reason we lose clients, surprisingly, when we looked across, and we now have data for more than 10 to 15 years, was not because of change of RM, it was not because of change of performance, okay? So the biggest reason for us to lose clients, and this was more than 35%, was because of transition of wealth from one generation to the other, okay? So actually that was the largest reason for us to lose clients. And we discovered that sons and daughters always believe their parents have not done a good enough job, right? So if somebody was conservative, the kids felt that he didn't take enough risk. If somebody was was willing to take risk, the kids felt, no, he should have been substantially more conservative, okay? So our ability to actually manage the expectations of the next generation, and especially through the transition, has ended up being the toughest. Obviously, we run a lot of programs today called Young Leadership Programs, Young Entrepreneurship Academy. We do a program called DIVE, where we're engaging with the kids between 13 to 27 now, practically on a monthly basis to try and build our engagement with them, maybe understand them better. But that in my mind, 35 to 40% of the time is the reason for losing clients. 25 to 30%, it was the feeling of not being cared for, okay, which was obviously being reflected from a service standpoint, or feeling that the relationship manager and the firm didn't feel that the money was important enough, or they were not large enough, or they just didn't feel important, either because of service or because of any other reason. 10 to 15% of the time it was performance, and 10 to 15% of the time it was actually the change of relationship manager. But 75 to 80% of time, it wasn't either of those two. It was just a generational shift and maybe lack of service. So that's something which I think all of us as an industry need to work. And I'm going to give a very, very bad example. You have to look at it with slight bit of pinch of salt, because I'm going to make it sound extreme to kind of prove my point. Okay. So as a firm, we started out in 2008, April 2008. That year, obviously, we had a revenue of 15 crores, I think, and we had an expense of 18 crores. So we lost 3 crores in 2008. If I just look at it very, very harshly on myself, okay, I'll say over the last 15 years, or 15 years we've been in business now, 2022, 14 years we've been in business. How much money have we spent for the last 14 years? Okay, so last year, let's say we spent 600 crores on multiple set of things, largely being employee cost. And I look at that for the last 14 years, on an average, we would have spent 350, 400 odd crores, okay. So we spent 5,500 crores on all kinds of expenses over the last 14 years. Today as a firm, if I just forget the revenue we've made for the last 14 years, okay, because that is in history now, that's either in our book value or we paid it out as dividends, okay. Life starts afresh today. The only asset we have as a firm, okay, the only asset we have as a firm is 2,500 family relationships who have, let's say, more than 15 or 20 crores of assets with us, okay, or we have 10 crores of assets with us more. So that number is all of 2,500, okay. So very critical way of looking and assessing yourself is we've actually practically in the last 15 years spent practically 2 crores acquiring every client, because that's our only asset, right? So our only asset today is those 2,500 clients, and we spent 5,000 crores over the span of 14 years to acquire those clients. So every client walking out of your door is practically a spend of 2 crores gone down the drain, apart from all the benefits and the limitations it has about him going out and spreading that word, right? So in some senses, 90% of our job is really to retain these 2,500 clients, and 10 to 15% of our job is to add incrementally as we go along. Lastly, I think this entire ecosystem on digital, fintech, can't be ignored. I think in our business, it's got 3 aspects, depending on the segment you're servicing. Obviously, if you're servicing the mass retail segment on the wealth management side, I think the highest kind of disruption happens there to begin with. Okay, we've seen that globally. The first disruption happens really on the brokerage side, which we've seen obviously in the case of Zerodha, Grow, and so on and so forth, who in some senses disrupted the market. Obviously, we've not seen a tough phase in capital markets. We'll have to see how some of the newer players respond to that. But obviously, clients or maybe investors with smaller amounts of money to start with are more keen sometimes to go the direct stocks and the direct bonds way rather than come into long-term wealth creation through packaged products, okay? And third, obviously, you'll see people like Scriptbox, Small Case, and so on and so forth, offer packaged solutions to these small investors. So if I, for the lack of a better word, I think 0 lakhs to 1 crore is where the highest amount of disruption will happen through the digital fintech universe. The 1 to 15 crores or the 1 to 10 crores, which is largely being serviced by priority banks, okay? And there's no right number of 10 or 15, right? Some of these numbers overlap, is where there will be, again, a lot of innovation. Obviously, there the priority banks have the highest amount of advantage because the cost of acquisition of these clients is the lowest, because you're kind of entering the bank to open your salary account. They see how much money you have on a daily basis. You are most likely the client who is going to take a home loan first. So they're going to be able to give you a home loan. They make money from your salary account. You do some forex transactions. So the bank has the highest ability to earn revenue and also the lowest acquisition cost. And for obviously boutique wealth, large wealth managers, it's sometimes a very tough segment to get into for the same set of reasons which I spoke about. The cost of acquisition slightly on the higher side, and the ability to book a spread of revenue is substantially lower. So 1 to 15 crores, I think, is where banks will continue to have a bit of advantage. Obviously, you have other boutique players who will come in, okay, to serve the mid-market segment and disrupt all of these. But they will have to do it very, very well. The overall platform has to be super comprehensive and the cost of acquisition has to be very low. And plus, eventually there will be 1 or 2 banks who will also get their digital platform bang on, okay? So if you see global examples in Singapore, for example, DBS has done a phenomenal job, okay, where it's able to compete with practically private banks at the lower end, okay, in terms of its offering, because it's got its entire tech architecture done extremely well. So I think the 1 to 15 crore segment will continue to be very, very heavy on the digital side, interface and execution. Above 15 to 20 crores is where you'll see the interface change massively thanks to digital. Client expectation in terms of in terms of analytics, storage of data, ability to interpret data, ability of the RM to slice and dice the data, his CRM requirements, his complaints. He would expect everything to be absolutely digitally enabled. What he's unlikely to do is go out and put in a 5 crore, 10 crore, 15 crore order to buy an AIF or to buy a bond. That's unlikely to happen. So eventually, I think digital will have a massive overlay across all these 3 sectors. The activity which it will influence within these 3 will be slightly different. So the first set of clients, I think, will be fully digital. Second set of clients will be, in some senses, phygital, okay? So the service could be digital, but a little bit of advice would be needed on the phygital end. I think the last one will be, again, phygital, but with a slight more bias to physical RMs and analytics and this thing more on the digital side. Eventually, just to kind of round it up and then head into question and answers, I think, just my learning in the business over the last 22 years is all of us are in a very high growth business. And as I said earlier, the beauty about the business is the attrition of clients can be super low. So every client we get, the life cycle can be 10, 15, 20 years. But there are some challenges to our business also, right? So challenges to our business is, I think, our clients are very, very demanding, rightfully so. Okay, it's their hard-earned money. And I think sooner than later, if we don't get all the 3 Ps, which we call internally people, product, and platform, correct, eventually we'll be having more and more coffee with clients. And they love our relationship, but they'll do less and less business, okay? And I'll end by saying that these 3 terms for us are very, very critical. And internally, we always say these are multiplicative functions and not additive functions, okay? What I mean by saying is if there's a firm A and there's a firm B, and hopefully we are firm B, but if there's a firm A, which is scoring 9 on 10, 9 on 10, 9 on 10 on each of these 3 parameters, and there's a firm B which is scoring 10 on 10 on these 3, if you add these 3, 9 plus 9 plus 9 will be 27, 10 plus 10 plus 10 will be obviously 30. So the second firm is only 10% worse off than the first firm. But in reality, that's not what happens. It becomes a multiplicative function. So it becomes 9 into 9, 81, 81 into 9, 729, relative to 10 into 10 into 10, which is 1,000, right? So the impact is nearly a 29-30% impact, okay? So what is a 10% differential on each effectively ends up having a multiplicative impact. and an impact of 30 to 35%. So if you're to remain integral to this business, I think investments on all three aspects, okay, which is people, products, and platform, needs to continue. The good news is we are in a very sweet spot, at least for the next 25, 30 years. And we'll continue to see a 20, 25, 30% growth in the business already, which I've outlined, broken into 3, 4 factors. And the trends are alive. Trends keep changing. Regulations will obviously come, but most of the regulations are for our benefit. For example, the advisory, the distribution split, everything takes time to adapt to. That's the big downside. But once you adapt, it kind of moves you progressively forward. So that's it from my side. Thanks a lot, and over to Anil for some questions. Thank you.
And a lot of learnings, and the way you articulated it in terms of how the business has grown and how you started, and some of the new trends that are changing was very interesting. And friends, I'm sure all of you must have also got a lot of learnings. But I'll share one small anecdote from my side personally, Karan. About like 8, 10 years back, I was given a mandate to start a very small venture in pension fund management, and it was very nascent. And I took on some learnings from your earlier one of the discussion where you said that when you were set up or starting your wealth practice, you used to identify or try to identify clients' wealth based on the size of their house in Delhi. So we were trying to do something similar, that we used to look at size of the company's balance sheet or size of the company's number of employees and trying to do that. Now connecting that in today's world, Karan, like, okay, you could at that point of time have a lot of physical touch points, connect, look at size of the house of the clients and try and approach them. But how can a wealth manager in today's world of, let's say, digital, technology-driven, come to that kind of some strategy?
No, so I think let me start off by saying those were good olden days, I think golden days rather, as a relationship manager. But life is substantially easier today, right? To take off your example, I think in Delhi, the only way to get to clients was, obviously you didn't have VC Circle, Deal Curry, and all the social connects you have today. But the ability was to really go out and see the size of the house, right? So we started searching in Okhla, Panchsheel Park, and these are really the places I still remember, D89 Okhla Phase 1 or W36 GK2. These were our first set of clients, which we ended up getting in 2001. Right? And they're still very large clients of the firm today. But kind of fast forwarding very, very quickly. From 2014-15, one of the biggest reasons for our success on reaching out to large number of clients is we built something called, and now it's no longer a secret, we have most of our competitors following it, so I can discuss it very openly. We built out a platform called Circle of Influence, right? So for every client who ended up getting a large pool of money, we started tracking something called a Circle of Influence. A Circle of Influence was nothing but through social media, essentially getting hold of the following details of the client, right? Which building does he stay in? Who are the top 10 competitors in his industry? Who are his board of directors? Who are the corporate lawyers he deals with? And effectively, once you map out these 4 things as circle of influence, there was practically a 99% probability, and you put it in a system, there was 99% probability that one of these 30 to 40 people in his circle of influence was already a client of ours. So it was virtually impossible for us not to have a good connect before we reached his office, okay? So we built out what we call as a circle of influence, okay? It could be lawyers, it could be the building he stays in, it could be his board members, or it could be the top 10, 15 competitors in the industry. Now, obviously, you have digital tools to do it. We are able to do it very, very quickly. You could go to pretty much any social media platform, build some macros, and I don't remember now who does it for us, but we've got it outsourced. We've got somebody who maps all these 4 parameters, and then we are able to compare it to our existing client database and at least get 2 or 3 circles of influence before we reach the client.
That's very interesting. And one more thing, like, do you think that when you are trying to attract this kind of big clients, is it a big brand like, okay, Mr. Karan from India Infoline Wealth or Miss X from IIFL Wealth is approaching them? So is it a big banner or a brand that is important to get clients onboarded? Or
it's a very good question, and I'm going to drop on my own personal examples. So I'll give you 2 examples, okay, or rather 3 examples. When I started my career in Kotak in 2001, I was in the Delhi office, okay, and the Delhi office had a whole of 11 people, okay. And Kotak in 2001 was a very large NBFC. It wasn't obviously a bank. In 2005,
Kotak
it became a bank.
KMFL,
Yeah.
yeah.
It was called Kotak Securities at that point in time in Delhi. And we were totally 11 of us. And unlike Bombay, nobody knew Kotak in Delhi. Okay, this is just not too long back, 2001. So believe it or not, I made first 10 cold calls just as a relationship manager. Delhi being Delhi, at least 6 people banged the phone down. But 4 people gave me meetings. Okay? And it's absolutely hilarious, and I don't know how you picked this question, but out of the first 4 meetings I did, the first 2 meetings, they thought I'm coming from Kodak. Nobody,
really?
No, because Kotak was not known. Okay, so they thought I'm coming from Kodak. Okay. The next 2 meetings was thinking that I'm coming from a security guard company. Okay, because of Kodak Securities. Okay. And obviously my size didn't help. Okay. So every time I entered the client's office, I was thinking the security guard was thinking his job is going to be in threat. Okay. Story didn't change much in 2008 when we started the business. Obviously, IIFL in 2009 as a brand was virtually unknown in South Bombay, South Delhi. In fact, 2009 to 12, it was virtually impossible for us to get a meeting on cold call. Okay. What we were able to do is any client who sold his business, okay, was willing to meet us, because at that point of time, they were willing to meet everybody. Okay. And I think till 2016 or 17, I think every second meeting we were confused with ILFS. Till 2015, we thought maybe it's a blessing. They think we are coming from a large company. After 2016, it was always a curse. Because every time we got calls from 3-4 cities from outside India, outside Bombay, Delhi. Arey, aapka company to band ho gaya, aapka company to band ho. So in that sense, brand is, it causes a perception before you reach there, but it's not all or nothing, right? So you have to work really hard. I think we could have done better from a perception perspective, but at the same point of time, I think 8 times out of 10, I would say what we've got is better than not having had it. And second, I think personally, I feel that eventually when you're sitting with the client, I would put the weightage of the brand as 25 to 30%. The remaining, I'm not ever going to say it's going to be 0.
Sure.
It is going to be 20-25%, but 75 to 80% is going to be the 3 things I spoke about, which is people, products, and platform. So, you know, if you're an independent financial advisor with a very strong focus on these 3, you are more likely or equally likely to be able to get the client today as much as any of the large guys. So I really don't see that as a massive handicap.
No, thanks. It was very engaging, and I mean, well, Kodak and Kotak I can still imagine, but the securities thing was very something unique, and yeah. So I think it's a great learning for all of us. You know, whenever you are trying to set up something new or start something new, I think it's not always the brand or the banner. Of course, that will be 20, 25, 50% maybe at some point of time. But more than that, it's about the value you add to the client or the things that you can put on the table for the client. I think that's going to be the crucial aspect. And let's connect that to one more point about the disruption and changing trends, like how you mentioned from then and now. And a very good point you mentioned that whichever promoter or whichever family has sold some stake or a business, you'd approach them. So now, I mean, do you see that outside like big cities and metros, like how do you see second, third tier cities, and is it a growth opportunity changing now? I mean,
massive, right? So every city at least has, you know, for us, where we are focusing only on, let's say, 15 crores plus today, every city in India practically will have, when I say every city, the top 50 cities, will have at least 25, 30, 40 families with this size. Today, we maybe reached out to only 15 to 20 cities, but whenever you go out to a 21st city or 22nd city, the ability to reach out to those 25, 30 people is very high. Where it's a challenge is resources, right? So the ability to recruit people in these cities, where we are able to train them, get them used to the product and the platform, and make them the people who are going to be equipped to be able to offer our level of standardized service to those clients, is where we are really facing a big challenge. But I'm sure over a period of time, by building a good hub and spoke model, we'll get there. But I think from a growth opportunity perspective, it's very large. Is it easy to service for people like us? The answer is no. Is it easier to service for people with large distribution centers, teams? Obviously, there are different challenges there. Maybe the product and the platform needs to be developed more. But overall, I think we've got a very good opportunity there, but we still need to maybe build our resources better in these locations to get there. And more often than not, I'm just taking off a previous point, I think what I've at least learned in life is the best time to start any business is when the chips are down, right? So 2001, obviously you had September 11th, and then 2008 you had the entire global financial crisis, okay? You end up being substantially more modest. You are able to attract more people. You don't build out crazy capacity. You don't spend crazy amount of money. And most importantly, you are substantially more humble about yourself, okay? Because you've just got a big lashing. And therefore, you want to be substantially more conservative in what you can build out.
Right. No, that's very interesting. And just a small add-on to that, somebody has asked from the audience that structurally, Karan, today we see, like you also mentioned, that number of taxpayers is very low in the overall context, and hence the number of wealthy families or wealthy clients, So is there some kind of course, your firm focuses on 15 crores and beyond. But if you look at, let's say, slightly lower, like let's say in the range of, let's say, 1 to 5 crores, how big would that population be? I mean,
no, that's the biggest growing segment. I think that's the biggest growing segment. I think our own internal data says our own addressable market today in the business we are focused on is only around about 200, 250,000 people, right? So if you actually see the same number for the 1 to 10, 15, 20 crore population, I think it will be at least, in my guess, approximately 20 times that number, 15 to 20 times that number. It will be 40 to 50 lakh people. And obviously then you've got another 5 crore people approximately who are paying tax, which will effectively come in the 0 lakhs to
much more smaller,
0 lakhs to the 1 crore. Obviously from a population of 130 crores, you've got only, I think, 5 or 5.5 crore people paying tax. Of that, there'll be 2.5 lakh people with $2 million plus of financial assets. You will get approximately 4 to 5 million people in that bracket of the crore to 10 crores. And everybody else will be more or less in the bracket of 0 to 1. But the more important thing is, as I said, both the number, the stock, and the life stage of all these clients is changing, right? So if you just take any large financial services company, technology company, or a new age technology company, the number of people who will end up between the 1 to 10 crores every year incrementally is a massive stock of people. So not only will you see the number of people go, you'll also increase, you'll also see the quantum of the wealth they have go up disproportionately.
Interesting, yeah.
And when we say we are 15 crores above, we obviously have certain profiles, right? So if it's a partner in a consulting firm like, let's say, BCG, McKinsey, Bain, as soon as he makes partner, most probably he'll have a financial asset pool of 2.5 crores. He won't have 15 crores. But over his 10-year life cycle,
it is quite definitely.
You are 100% sure he'll get to 30, 40 crores, right? So is that a client you want to service or is that a client you don't want to service? These are some questions which will overlap some of these segments. And irrespective of which segment you are, if you're in the 0 to 1 segment, obviously you want to see how you can sustain with the client in his life cycle. Or if you're in the 1 to 10 segment, you want to figure out how you can, or if you're in the 10 plus segment, you want to catch them young.
Catch them young.
So some things will always overlap.
And one more thing around that, and you touched upon it very beautifully, Karan, that how the global trend has been in terms of the rise of passive investing with ETFs and index funds. And in some form or fashion, that could reduce the, I think you used the word, I think fee-paying pool, or the overall mix in a client's portfolio, of that.
See, I think in India, mutual funds and ETFs have a huge structural advantage, which is going to stay, right? Your dividend received in the mutual fund is not subject to tax.
Correct.
You're saving 70 basis points upfront. NPV of that 70 basis points over 10 years is nearly 2.5%. Next 9 years dividend NPV is nearly 10 to 12%. You are able to set off your fee in the NAV itself. In a PMS or an AIF, you're not able to set off the
cost
fee.
of the fee. Yeah.
The tax is postponed at the point of redemption. In an AIF and PMS, you're paying tax every year when you sell. So I think more or less, to put it, the multi-cap and the large cap strategy will largely remain limited between ETFs and mutual funds. Mutual funds structurally, obviously, as each scheme becomes very large, finds it difficult to beat the ETFs.
Underlying ETF.
So outside of that, I think mutual funds will continue to grow. Very large mutual funds will find it difficult. Clients will become slightly smarter. They will not necessarily say, I have to find one scheme which is going to beat the index. But the 5 schemes which I select, are they putting together beating the index or not? Because for me, the only way to do it is to invest in 5, 6, 7 schemes. At the end of 3, 5 years, I need the average of these to beat the index. I don't need one scheme to beat the index, okay? And therefore, that might push them a little bit to ETFs, because the only way to choose those 7 schemes, we have a bit of a recency bias, right? Which schemes have done well over the last 3 years. So I think put together, I think on the large mid-cap and the multi-cap side, mutual funds are here to stay. Very early pipe kind of strategies will move to AIS. And the late stage multi-cap, I think, will remain in mutual funds. And large cap proxy to the economy will more or less move towards the ETFs. So I think all large four will have a play. Incrementally, you might see the largest flow to ETFs because from a stock perspective,
block of money is
from a stock perspective is the lowest today.
Correct. And very interesting, and that's how the innovation also will happen in the industry, like you mentioned about the pipe and all. I remember you were the first to come up with the pipe kind of a fund, I mean, for
and
clients.
The lowest, and there will be a lot of innovation on ETFs also.
Right, yeah. So broadly, I mean, it will be like a sort of polarized market. One end of the curve where you said large and multi-cap will be there in low-cost passives, and then there will be the very specialized AIF.
I think there will be space for everybody, right? And these are such long-term trends that they don't happen in 3 months, 6 months, right? So they are fairly longish trends.
Correct.
But obviously, you can get the trend very quickly by looking at the market share on an incremental basis rather than on a stock basis. So
that's right.
So that's really what we have to look at.
Correct. And Karan, how do you see the connecting the dots of how you said the second, third tiers growth in cities, smaller cities, and technology, how it's disrupting? So how do you see robo-advisors in this space, especially let's say not the 15 crore and very niche client, but let's say the 1 to 5 crore.
So as I said earlier, I think 0 to 1 will move more or less to some kind of robo-advisory. I don't like to call it robo-advisory, but
technology-driven technology-driven.
There will be technology-based solutions which will be there, right? Whether it's script box, small case, whatever, 10,000 of them. They will also have a little bit of more appetite towards doing direct stocks, direct bonds, direct trades. I think the 1 to 15 will be phygital, right? So there will be some bit of what COVID has taught us is that they are willing to do a review online. They're willing to get onto Zoom, assess their portfolios. So they're very happy to operate in a phygital world. For players like us, we can now dream of being in that segment because suddenly the span of control for a relationship manager can be 60, 70, 80, 90 clients because he's servicing them digitally also. As opposed to, let's say, on the 15 crore plus side, where the client is still expecting you to meet him once in a fortnight or once in a month, which is a more physical approach, where the span of control can't be exceeding more than 25 to 30 clients, right? So I think in tier 2, tier 3, again, I think it'll still be a function of size. It just won't be a function of geography. I think as the clients become from that 1 to 15, I think there is an ability to kind of do a phygital approach with them.
And then in that, maybe it could also be like you beautifully mentioned that wealth management, and we have all studied it in our curriculums and in our ongoing knowledge enhancement, that it's split across like wealth accumulation phase. Structurally, we all to a great extent focus on that, but also important the wealth decumulation and then the wealth transfer, So maybe in all of those, the second and third phase, there you can't have technology or a robo-advisor type of approach. You need the physical touch point, you need somebody who can connect, talk to them. Customized solution is, I think, crucial.
No, I think it's critical. So I think, especially entrepreneurs who've created wealth themselves over a large period of time, they want to have a bit of touch and feel. They want to. It's a very different activity, right? Because investing is not a wealth creation activity for them, because wealth creation for them is already happening in their
business,
in their core business.
Their core business, yeah.
So they're coming here for wealth optimization and very few for wealth preservation. So wealth optimization is practically targeting a return of 9 to 11%. Wealth preservation is coming down to 7.5, 8 or 7. But wealth creation, which is the focus, is 18, 20. You'll have only 3 or 4 people, right? You'll have Damani, you'll have Mr. Junjunwala, focus, because that's their core activity. So they are doing wealth creation through this activity. But 95% of our clients are doing wealth creation in their day-to-day business, where they're spending 24 hours dealing with all the issues, dealing with the factory issues, dealing with tax, working on Sundays, spending their brains out on that, and then getting to the 25-30% return on their capital employed in the business. So most of our clients would go for wealth optimization, as we like to call it. They don't go for wealth creation. At the same point, they are not necessarily in the wealth preservation bucket.
So the technology...
And that's the biggest conflict with the next generation, right? So the next generation sometimes, after having studied outside, wants to achieve wealth creation through investment.
Through investing,
So that's the bit of a pull and push between the next generation and the current generation.
Correct. So in this disruption, maybe we will see some kind of disruption maybe in the wealth accumulation phase, But in the other phase, the thing
I would fully agree with you.
remain that way. And also interesting to hear how the learnings from your journey can be used, though it was, let's say, about 10, 15, 14 years back when you started IIFL Wealth in a small platform. But maybe in the disruptive world, how it's going to enhance, and it can be good learnings for whatever we think in the next 5 to 10 years coming. Maybe it won't be another 10 years, but maybe another 5 years, how the things will going to
Some things
change.
remain the same, yeah. Nothing changes, Anil. So, two things which have remained the same for me, and they're really boring, but I'm going to say it since you've spoken about it. The two things which have, nearly out of time, so two things which have really helped me over many, many years, and all of us sell in some way or the other, right? So I think the one thing which really helped me growing up and even today is practicing in front of the mirror, right? So if you're going out and going to pitch something to anybody, you need to be convinced about it yourself, right? So if you're going to pitch anything, you need to kind of get it down to 5, 6, 7 important sentences. And I used to love practicing in front of the mirror because by the end of 5 minutes or 7 minutes, I was convinced of the 6, 7 points I'm going to kind of go and pitch, and I was convinced that the other person is going to understand. And second thing which has really helped me in my job, and maybe some of you, since we are fortunately or unfortunately in a job of managing money, we obviously don't need to be math scientists or wizards, but everybody loves anybody who can do quick maths and multiply tables fast. So I really made it a tough exercise on myself to memorize tables from 1 to 30.
Oh, really? Okay.
And it really works, right? So because you're able to do commercial maths very quickly, not differentiation and integration.
Not differentiation,
so
yeah,
not as
correct.
fast as the CFA guys,
No.
but commercial maths really kind of helps in many ways. So I think apart from that, some things have to be basic. So when the client's meeting you, these things will never change, digital, non-digital.
Correct.
Obviously, once digital comes, the ability to implement, execute, evaluate, all of those things will continuously change
Keep
and
changing.
keep improving.
Yeah. Wonderful. I think, as I said, I have had a lot of learnings from your sessions earlier. You spoke at CFA conference also in the past, and some of the things that you write. But even today was an excellent session. Lot of learnings. Speaking in front of the mirror. Very often it's an old age thing. You learned it in college maybe, but how to put it to practice. Not just before what I did coming today morning for meeting with Karan and in the session, but even before going to a client meeting, make sure we can spend. These are small learnings, I think, which will go a very long way. Karan, it's always a pleasure to talk to you. And
thank you, everybody.
Thank you, everyone.
For having me here. Thank you.
Thank you very much. You have always been kind supporter of the CFA Society India platform. I really appreciate it. Thank you.